Hello, this is Kevin Prince from BMO Exchange Traded Funds, and welcome back to our weekly Market Insights webinar. We did take a break last week, of course, for the Canada Day law. We kind of made it a long week, and I did. But welcome back one more time. And we build this seminar and this presentation on a regular basis based upon the questions and answers that questions that people send to us on a regular basis. And that really helps us build the content. And one thing we heard from a lot of people out there was more questions on sectors. So you know what? We decided to build this webinar here. We're going to take the next 30 minutes and we're going to focus in on sector and sector investing. We have with our colleagues the FTSE, I'll do an introduction in a second, FTSE Russell that is, and we're going to dive into the overall topic of sectors themselves. Now, one quick thing, of course, you'll get, there's a replay for this, and I will encourage everybody at the end of the session, we're going to give you a survey. And of course, you can, again, next time around, send us some more questions. And that, again, helps us not only answer the questions at the end of this session, but also build content going forward. So thank you again for participating. And thank you for sending in your questions for those that do that. Appreciate it. With that, let's get in there. Ultimately, I want to give you a couple disclaimers right off the bat. Of course, our disclaimers are that we're not giving you advice here. We're really giving you market insights. And just one more time, also from FTSE, really, it's not recommendations. It really is market insights across the board. So who do we have joining us today? Well, Francis Kim from FTSE Russell. We're going to explain who FTSE Russell is. If you haven't heard of them before, I'm going to encourage you to Google that in a little bit, as well as Mackenzie Box will be rejoining us from BMO Exchange Traded Funds. With that, let's spend some time on FTSE Russell because we do have Francis Kim here. And Francis, maybe give us a little history about FTSE Russell and your ownership, I guess, aspect, but also talk to us a little bit about your Canadian connection and your fixed income aspects, please.
Hey, thanks, Kevin. Yeah, thanks for inviting me to this webinar, and really appreciate it. Get to talk to you about FTSE Russell and ICV. And just to give a brief background for the investors, the FTSE Russell, you may not know, or you may know, is under London Stock Exchange Group umbrella. And we have a pretty good presence in North America, along with FTSE Russell indexes. London Stock Exchange acquired Yieldbook and Citi fixed income indices businesses from Citi back in August 2017. And now we're able to offer clients with a comprehensive index solution across both equity and fixed income. And I would say we're one of the few providers out there now offer a meaningful balance between both equity and fixed income indices. So our business is really embedded in the global market, and our services are chosen by many of the large investors around the world. So if you jump into the next slide, we want to just give you some numbers and figures representing FTSE Russell Index. As an index provider, we provide a diverse toolkit for fund managers and ETF providers. And in an increasing competitive environment, product differentiation, quality, and brand visibility is becoming more important, and especially for our fund managers and ETF clients. So many clients choose to work with us because of our index solution and bespoke solution that could help them differentiate themselves and provide value to their end clients. So that's a brief introduction for us. And we could dive into some of the sector indices.
Perfect, thanks for that. And just one quick thing, could you do me a favor? Could you just make a quick shout out about your URL for your website itself? Because I want to highlight that it's a great tool for some additional research out there across the board. So you can just share with everybody your URL if you can, please.
Oh, sure. It's www.FTSERussell.com.
Perfect. And for those investors, out there, great resources around fixed income, some recent COVID coverage too, for that matter. And of course, we're going to spend a little bit more time on sectors here too. So lots of content there. And for the perspective for the investors here too, FTSE Russell is kind of dominant in Canada around our fixed income indexes, and have the legacy of actually owning some of the indexes that go back many, many years in Canada, more known indexes when it comes to fixed income across the board. So with that, let's jump into the concept of sectors. And I want to give you a little bit of foundation and some background first before we get into some of the indexes and how they work in construction around it, some considerations around that. But ultimately, if you're thinking about sectors and sector investing, what you probably know by now is that there are different times out there that sectors can be doing better than other sectors, right? And it certainly is market and market cycle related, of course. And so here's an example of we actually call this a jelly bean chart, but here's a because it looks like that. But here's a chart quickly showing you that at different times, different sectors are either the top or the bottom, and they rotate through their position on a regular basis. So really, what a lot of people look at sectors and sector investing is either a core, as in maybe using that as a core for your where you want to be in the marketplace, or as a satellite by saying, let me start with a broad diversification and tilt across the board with respect to different sectors to maybe pull in that energy or the financials or consumer staples and consumer discretionary, which we'll spend a little more time on that later on today. But definitely think about sectors as a way of tilting or complementing your portfolio across the board. And if you think about in Canada, for example, the broad market in Canada, you're going to hold a lot more financials, a lot more energy and materials. Maybe you want to complement it, or maybe you want to have a little more information technology because you're liking that sector and you want to play in that sector, for example. The other aspect when you think about sector and why sector investing is important, think about trying to put together a portfolio of a sector. And my favorite example here, staying with that technology theme, of course, is Amazon. The current share price at Amazon, well over $3,000. So to buy 100 shares of that, that's going to take a little bit of somebody's portfolio up, and that's not diversification either. And that's why sector investing, maybe through ETFs, may make sense, because you're getting that broad diversification across the board. Again, we're going to have FTSE up a bit and talk a little bit about some of their indexes, but for example, in consumer staples, consumer discretionary, you got between 159 and 139 different holdings. And, think about that in diversification. So really, sector ETFs offer that way of accessing that investment thesis, but doing a more diversified basis and allow you to participate at much different levels than you could if you're trying to buy, again, 100 shares of Amazon, for example. And the other aspect, too, that an ETF offers in this marketplace is you can tactically move between one sector and another sector with a simple button, right? Triple trade back and forth. So think about that as a way to develop your tilts in your portfolios across the board. Now, with that, there are, of course, some key considerations. And one of the key considerations when you're thinking about diversification and thinking about portfolios and construction is what are you putting in your portfolio? And part of that is how it's actually weighted and constructed across the board. So I'm going to reach out to Mackenzie and ask her to talk about two of the approaches as we lead into the approach for that FTSE follows across the board. So maybe Mackenzie, you could talk to us a little about market capitalization and equal weighting for approaches.
Thanks, Kevin, and thanks everyone for joining today. There's definitely a few different approaches you can use when it comes to sector ETFs. The first being market capitalization, which is probably the most commonly known and commonly used strategy, as it provides more of a pure sector exposure. The one thing to keep in mind, though, with market capitalization for sectors is that you may be overly concentrated in select securities. And another common approach to sector investing is equal weight. So this is an effective strategy. It helps reduce your security concentration risk, especially in concentrated sectors and markets like Canada, for example. So this really allows the portfolio to reduce single stock concentration and provide a more diversified exposure. Now, with equal weighting, you're more likely to see a bias towards market cap or towards mid capitalization security. So on this slide here, I put together a quick example of a few different ETFs that provide exposure to Canadian REITs. And you can see the number of securities and the weight specifically in the top 5 holdings vary dramatically. And, ZRE, which is BMO's equal weight REIT index ETF, is equal weight. And if you look at the top 5 holdings going across the board against XRE and VRE, you see quite a dispersion, not only in the actual securities, but the weight. So, looking at the way an ETF is weighted, especially with sectors, is definitely something to consider.
Yeah, absolutely. That's a key part of building anybody's portfolio is thinking about the holdings, because an ETF is always just going to reflect the performance of the underlying holdings themselves. Hey, Francis, let's go back to you for a second here. Let's talk about, kind of that hybrid middle ground, an alternative approach to market capitalization. Take us away with what you've been doing on the FTSE side.
Sure. Thanks, Kevin. Thanks, Mackenzie. And it's a great segue just to kind of show the different kind of a flavor what FTSE Russell could offer. So when you're measuring your performance of your investment portfolio, it's important to understand what your benchmarks against, right? And you need a real comparison, apple to apple comparison when you're looking at your investment opportunity. So best example is to design an index based on FTSE Russell's in transparent index methodology and then tailor to the specific opportunity set. So let's highlight the basic construct of this index in the discussion today. So FTSE developed ex-Korea cap 100% hedged to Canadian dollar index, which is which includes the large and mid-cap companies from FTSE developed ex-Korea index, and it follows the standard review schedule of FTSE Global Equity Index Series. And indexes are capped at quarterly basis with no stocks having weight greater than 10% of the index at the review. And this index also provides a great exposure to global and domestic consumer discretion and consumer staple stocks, and it minimizes any kind of overweighting of any single stock with that routine maintenance. And it's also currency hedged back to Canadian dollars so that it helps Canadian investors minimize currency risk holding stocks traded in a foreign currency. So in the next slide, we'll focus more on the consumer discretion and staples aspect using the ICD framework or industry classification benchmark, those that are not familiar with those acronyms. And as most of you might be aware, the consumer discretionary and consumer staples category has become increasingly common for investors to separate stocks into a cyclical, more defensive categories as a way to identify opportunities and manage risk at different stages of economic cycle. And Kevin showed that nice jelly bean picture as well in the earlier slide. And we want to highlight this index performance characteristics of the consumer discretionary index at the close of June 30th. So as consumer discretionary companies, tend to ebb and flow with the economic cycles, and stocks typically perform more in line with market growth and expectations and risk appetite. And in this picture, we just want to highlight the overall performance of that index and just give you a brief index characteristic of that index. And as in terms of those that are interested in global versus domestic exposure, there are 356 stocks in consumer discretionary index, and about 115 are from North America, and they take roughly about 65% of the total weight. And rest are global stocks, which accounts for the rest of the weight. So it provides a nice broad exposure both for global and domestic stocks. And the next slide, I'm going to show the top 10 constituents of the index by weight. So you can see that number of indexes constituents within this table. The familiar names like Amazon, big retailers like Walmart, and the giant media companies like Walt Disney and Netflix are included. And also for global, those that are interested in global exposure, you see the Toyota Motors sitting at the top 10 constituents. And there are other automakers such as Honda and Volkswagen are included in this index as well. And other consumer good providers such as Louis Vuitton and Sony is also included in this index. And just want to quickly highlight that the Amazon's percentage is you can see that 10.68%. Please note that the actual rebalance of the review it occurred in June 19th. So you can see the change of the weight from 10% from June 19th to 30th from that original 10% of the cap. So you can see the effect and the changes from the last quarterly rebalance. All right, the next slide, Kevin. It's the opposite or the contrast, I guess, with the one we previously discussed. This is a view of the consumer staples index. And as by contrast, consumer staples company provide essential everyday products and services, whose sales are typically not really tied to the economic environment. And they, traditionally their stocks are supposed to offer a defensive quality and tend to be less volatile. And even when the markets are kind of a risk averse. And this slide just shows the performance of that index and the characteristics. And you can find more in our fact sheet at FTSERussell.com. And for the global versus domestic exposure index, out of 159 consumer staple stocks, 42 are in domestic with about 52% of the weight. And in the next slide, we want to show the top 10 constituents of the staples. And you can see there are a lot of food producers. Nestle is included. In one of the global more personal care products like Unilever is included. And there are other companies like Tesco that are included as well. They're all part of the staples family. And same thing as noting the index weight, you can see that Nestle is sitting at top, slightly over 10%, going over that the quarterly rebalance capping that occurred in June 19th. So that's a brief overview, and there's more information at FTSERussell.com regarding these indices as well, and the fact sheet that accord with it.
That's perfect. I mean, that's what we want to do, is give you a foundation of the different types of constructions, and dive a little deeper into this one, because we're going to spend a little more time on rotation of consumer staples, consumer strategy in a second, but we want to give everybody an understanding that there is a little bit more to it when you think about sector investing. The construction of the index is important, and take a look underneath the hood across the board, because that's what you're going to perform in. That's going to be the key part of your performance, is what's underneath the hood there. Mackenzie, maybe we can bring you back in to talk about a little bit about now this, implementing sector investing across the board. Different thoughts out there how to implement. Maybe you can walk us through the economic cycle and the market cycle approach for sector investing as a complement or either as a core, I guess.
Yeah, thanks, Kevin. So economic cycles will always drive the market, and things will fluctuate during different economic cycles, like we're seeing in the current market. And market cycles are really going to drive the sector rotation. And there's times where in the market cycle, you might want to be a little bit more defensive. So maybe think utilities and healthcare, and times when you want to be a little bit more cyclical. So you think financials and industrials. Now, I wouldn't say this is always a perfect science, but generally when markets correct, you may want to be a little bit more defensive, and when markets are doing are a little bit stronger, you might want to be a little bit more cyclical. So if you think now, utilities and healthcare are a really great place to be, as we've seen in the last couple of months.
Yeah, exactly. I mean, and you're right. It's not a perfect science, but it is kind of a framework, and as people can think of things as being more defensive or more optimistic across the board. And then, of course, layer on top of that, maybe there's a thing like information technology in this current market you want to be around too, as kind of that, exposure play you want to bring in there. Mackenzie, just a quick little snapshot too, because here's the lineup of the BMO ETFs that lay into that framework. But in addition to that, we can quickly highlight too, you can also think about domestic versus global too. We did talk a little bit about global. There's also domestic kind of exposures. Mackenzie, when do you want to think about maybe a domestic exposure versus a global exposure? Walk us through why would somebody go one way versus another?
Yeah, and I think it's it's not always just about being defensive or cyclical. I think you have to think domestic. So maybe especially in Canada, you maybe think like oil and gas, or our financial, the banking industry, if you will. And then global, you might think about something like materials, and in some cases you might want a bit of both. So it kind of just depends. But I think taking a, defensive approach, whether you want to be more defensive or cyclical, or where we are, but then also layering on, a geographic lens from, ranging from Canada to more global. BMO ETFs as a whole, we have a great offering that kind of allows you to position your portfolio given different market cycles, and then as well on your geography and where you want to be.
And I think you make a good point, ZEO, with that, petrodollar of ours, maybe that's more of a domestic thing versus more of a global aspect out there, maybe for other mandates. And we'll spend some time on the staples and discretionary. Mackenzie, maybe talk about us now. I know you did an example here. Talk us about an implementation of maybe a sector approach. This is an example out there. It's not a recommendation, but it's an example out there.
Yeah, sure. Thanks, Kevin. And yes, this is not a recommendation, just an example and more of a steady switch trade that's been done based on historical data. And this has really been driven from Don Velo, who's done a lot of work in this area. And what it really is a switching strategy between consumer discretionary and consumer staples. And the trade or the kind of strategy is that you trade on 2 days per year in April and October. And what it really states is that they deliver outperformance over the broad market by executing that. And so the foundation of this strategy really capitalizes on the seasonality of the performance between, the more defensively oriented consumer staples sector and the more cyclically oriented consumer discretionary sector. And that's really underpinned by factors being that from late October to April, consumer discretionary has tended to benefit from increased consumer spending. You think Christmas and holidays and whatnot, where in contrast, consumer staples have tended to outperform when investors have favored earnings stability during the other 6 months of the year. So if you look to the next slide, here's the example, and I think this is a nice visual. The historical results of the switching strategy, so this is going back to 2000, yielded significant outperformance versus buying and holding exposure of just consumer discretionary or staples, or the broad market for that matter. So significant outperformance and less volatility as well. So definitely something to look at, and definitely of interest to see how that performs over time.
Yeah, great example of how you can rotate through. And I mean, it kind of puts a challenge on the old sell in May and go away. Maybe it's switch in May kind of thing. So take a look at that. If you're looking for more information on sectors, certainly take a look at our website, bmoetfs.com, or FTSE's website too. But I also highlight, if you're looking for more information on seasonality or switching stuff, take a look at the website equityclock.com. On there, they've got a lot about seasonal rotation strategies. This is just an example of one that's more popular out there. And shouts out to both Don and John Velo for their research in that space. With that, let's get into some of the questions that came in this week. Got a bunch of good questions, and let's jump into some of those right now. First and foremost, Mackenzie, somebody's out there asking about how do we look at the performance of the ETF and the performance of the index? Where do I find that? I think you might be on mute, Mackenzie.
Yes, I am. Thank you. Great news for our website, bmoetfs.com. We have a tab on performance. So under each individual ETF ticker, there's a product page where you can go in, and there's a performance tab that displays a growth chart of the ETF versus the index. And if you scroll down that page, we also highlight returns of the ETF versus the index, so calendar, annualized, and cumulative. And I would note that most most ETF providers in Canada do display this information on their website. So just make sure you're going to the respective ETF website and looking there.
And just to highlight, we also post all of our holdings, and that's also updated every day on the website too. So if you want to know, going back to what Francis was talking before, what the holdings are in the underlying securities with inside an ETF, you can go to the respective companies' ETF websites, and it'll give that information to you right across the board. Keeping going on the questions here. Francis, over to you, actually. So let's talk about sectors, and specifically, what's your rebalancing and reconstitution? Fancy words, maybe you can walk us through those too, but effectively, what is your rebalancing and reconstitution for your sectors?
When we're talking about the FTSE indices, it generally follows our semi-annual rebalance schedule, which occurs in March and September. So what we mean by rebalancing and reconstitution, it's an adjustment of a market cap threshold, how we adjust and review the stocks and segment by large, mid, small cap, and even micro cap to make sure that they're segmented at a most frequent basis. They are reviewed at a semi-annual basis, but along that, we have a bit of a rebalancing, I would say, in adjustment at quarterly basis, make sure the additional IPOs are added at a quarterly basis. And most of this information could be found in our website. And also, we pride ourselves in our transparent methodology and ground rules. So, when you're looking at the construction of the index, it is displayed out there in the specific schedule for various indices in our ground rules.
Perfect. Thanks for that. Mackenzie, got a question coming in for you in around gold and gold ETFs. I mean, does it make sense? I think you can give us some background on that and some support we've already provided in that space, but also want to know about what ETFs they have available in this space around gold. Certainly been a popular conversation lately.
Yes, it's definitely very topical right now. Seeing lots of news about gold in the media and whatnot. But we did actually do a webinar previously on this, on gold itself, on May 8th. So I would encourage you to look back to that. These are all recorded and available. So if you do want to learn more, dive a little bit deeper, I would encourage you to look at that. But when you think of gold, there's a few different ways you can play it. So there's equity, there's physical, and then there's futures. So under equity, there's also juniors, which is kind of your highest capture, greatest risk. And then there's also the seniors. And at BMO ETFs, we actually have two ETFs. So we have ZGD, which is our global gold. And then we also have a junior, which is ZJG. So I think, both great options, just depending what exactly you're looking for.
Well, thanks for that, Mackenzie, and good insights again. And I do encourage, there's a great repository of previous webinars. I think we're kicking around 14. This is probably our 15th one now. Each one about half an hour in length. Very proud about the content. Every time it's different. And again, built upon the questions that everybody provided. So I encourage everybody to take a look at the inventory of content out there across the board. Let me advance here. So there's been an explosion of day traders in the overall market there we've heard about. Certainly been a good part of the media. I think people have more time in their hands. Mackenzie, how does this affect the price of ETFs, especially on sector basis? Maybe give us some background around that. I know you've done some research in the past, so walk us through that.
Sure. Yeah, and I think we've kind of seen the explosions everywhere. We've seen markets, rally and fall. So I mean, I think there's lots in the media about markets right now, and I think we're seeing a lot of reaction to that. But when we think about how this impacts the ETFs, if there's a market event or there's a large move in investor sentiment, the ETFs move with the market. And I think that's always something that you need to consider and also remember when we're thinking about ETFs. And a few weeks back, we actually looked at the financial services sector or industry in Canada and the trading of our ETFs and how it impacted the price. And when we dove a little bit deeper into the stats, it really had no impact. And, when we talk about these equity ETFs, especially in different sectors, we're a pretty small part of the overall ecosystem. So it's not a significant impact. ETFs will not be driving the market. If the market is hot, we'll always participate in it. But we're definitely not, we move with the market and participate in it, but definitely not a significant impact to the ETF price.
Yeah, well said. I mean, you're just, we will, if the market is moving towards technology, and ETFs, of course, will rise with that, but ETFs won't drive that movement towards a certain part of the marketplace. Just a good vehicle to participate in across the board. And you would never, because the ETFs exchange with the underlying exchange with the ETFs, they will always move together in tandem. So, and a good point on that. And we also have some good research on that too. talking about the banking and financial sector. Thanks for highlighting that there, Mackenzie. You know, a question came in on another product out there, and this is one available in the States. The ticker coming in is IVOL. I must admit, we're not experts in somebody else's products. Always take a look at somebody else's products on their websites across the board. But really the question is, looking at this as an investment, giving taxes and currency, and bear with me, it's a fixed income investment. And does BMO have anything like that in Canada? Whenever you look at an ETF, and even including a BMO ETF, it's a kind of a good idea to kind of take more of a due diligence approach. I mean, you probably have a thesis or a thought process that you want to have for your portfolio and what this asset is going to do for you in your overall portfolio. The key is to make sure that when you're looking at that ETF, don't just follow the name of the ETF out there across the board or even the marketing around that ETF. Take the time and effort and look underneath the hood. I mean, Francis did a good job here today and really showed you some of the individual holdings that you've got within inside that particular index. And that's the same kind of approach you may want to take a look at when you're buying something else in the marketplace. Take a look at the holding, take a look at the construction, get comfortable with that across the board, but also take a look at the company itself, right? What kind of provider in the marketplace? And a couple more things I'd say is take a look at the assets within inside that ETF. Is it been more popular? Is there a wide bid offer spread? Of course, the spread between the bid and the offers and another cost you have to pay beyond the fee itself. So in this case, it's a fixed income ETF. And really what the fixed income ETF is doing is it's holding a low risk investment like T-bills and then using the balance to hold some derivatives to get alternate exposure. It's more active in the marketplace. So does BMO have ETFs in this space? Well, we have ETFs that do kind of the fixed income, kind of hold that core low risk aspect, but bring in derivatives to get exposure to the marketplace. Now, don't get a little confused there. When I say low risk, it's not that the ETF is low risk. It's just that effectively it's holding that to be the counterbalance to the higher risk that comes from that one smaller segment it's going into. So again, when you're looking at something to invest in, if you're not comfortable with how it works and don't fully understand how it works, maybe that's not something for you to move into. But if you're comfortable with it and comfortable with the type of strategy it does, this is more of a strategy-based ETFs, certainly take a look at that as a complement to your portfolio. That being said, when you look at fixed income across the board, you know what? Actually, some core fixed income, going back to what we're going to talk next week about, and I'm encouraging everybody to come to that session in regards towards fixed income. We're going to talk a little bit about the broad market. If I look at the broad market in Canada, represented by ZAG is our ETF in that space, and it is actually a FTSE index too, for that matter. Nice tie-in. What you're seeing is on the 1, the 3, the 5, and the 10-year period, first quartile across the board. So sometimes just focusing on low cost, simple base investing is a good way to start off and build a good core around fixed income. But if you want to complement it, I'm going to encourage you to take the due diligence approach to when you're investing in something and take a look at it beyond the actual themes, and hopefully that gives you some insights across the board. Now, I want to highlight what we're doing next week. And first and foremost, before I do that, I want to thank Francis for taking the time to join us this week. Mackenzie, always good to have you back in this session. We're going to be back next week, July 17th, again, one more time, 1 o'clock. Once more, we're going to bring FTSE in. Now, FTSE is, Francis brought off, has a number of different solution sets they brought to the market for indexes. We did talk about the sectors today, but want to spend a lot more time in the next 2 sessions, not this one, but the next 2 sessions talking about fixed income investing, specifically fixed income ETFs. And we're going to dive real deep into the broad market and broad market construction and around fixed income ETFs. And then the next session after that one, we're going to talk about tactical investing through fixed income ETFs. So look forward to having you all join us again next week, 1 o'clock. Also appreciate if you can take the time and effort and send us a couple of questions, because as you see already, it really helps us drive our content on a go-forward basis. And we're really happy to help you provide you this in this market situation as we're all going through it together. Thanks, everyone. Have yourself a good week. Talk to you next week at this time.